Hey guys, just wanted to talk to you about interest rates for a moment. I know a lot of people looking to buy or sell real estate are very curious about the interest rates and the direction of the interest rates. So I want to take a moment and give you my take on interest rates. First of all, I think a lot of people look at interest rates and they put a lot of importance on basically the Fed rate, the Fed money rate. They watch basically what the Fed is announcing, how they're going to be raising rates. And in my opinion, if we were talking about just Fed rates, um, I do not believe they're going to be lowering interest rates anytime soon. Currently, jobless claims are actually going down and remaining persistently low. Jerome Powell has made numerous comments that they don't plan on slowing things down or lowering interest rates until the economy starts slowing down. Now we are seeing some hope in personal PCE, which is personal consumer expenditures. This is basically a measure of how much people are spending out of their budgets. That number has dropped. So what that means is consumers are starting to slow down. The economy is starting to slow down. So that's a positive sign. But again, I personally believe that until jobless claims begin to increase, I don't believe the Fed is going to be raising or lowering interest rates anytime soon. Now, the Fed rate is important, but I think a more important indicator to look at when talking about 30-year fixed mortgages is the 10-year Treasury bond. Um, I believe it's much closer correlated to interest rates, and on average, the gap between the 10-year Treasury bond and 30-year fixed rate interest is about 1.7 percent or 170 basis points. But right now, that gap right now is around 3% or 300 basis points. So what that means is one of two things. Either interest rates are getting ready to drastically decrease to get that gap closer to match the 10-year Treasury bond, or in my opinion, what's more likely is that investors are actually getting a little bit skittish about the real estate market and they're placing more risk on mortgage-backed securities than they were before. Because like I said, if mortgage-backed securities was only a 1.7% difference between the 10-year Treasury bond, well, that's more along the average. But right now, the interest rate is 3 percentage points higher than the 10-year Treasury bond. So that means investors are not willing to invest without a higher payoff, higher reward. So I think it's going to be very important to watch that gap over the next few weeks and months. If that gap persists, if we continue to see a 3% gap, that tells me that there's actually something more systemically wrong in the real estate industry. Now, if rates begin to quit, if that gap begins to close, even if it's a little bit slow, but as long as that gap doesn't get any bigger or persist that wide, then that means, we're probably looking at lower rates. I can tell you from the Fed side, they're not really indicating lowering rates anytime soon. So I think the only thing that you can really watch right now is the 10-year Treasury. Now, again, I don't believe that you should time real estate transactions solely on the interest rates. There's many reasons. Well, you could want to sell. It's not always a buy situation. There could be times when it's advantageous for you to offload properties and recoup that cash to put into other investments. So if you're thinking about either buying or selling and you need somebody to sit and look at your individual situation and figure out what the best move for you is regarding your financial status and your real estate portfolio, feel free to reach out to me. I'd be more than happy to help you out, and look forward to hearing from you.